Good morning, everybody. Thank you for joining us. Hugh Robertson is my name. I'm talking as the chairman of Credit Clear. Nobody's here to listen to me. The point I just wanted to make was, if you're a shareholder, thank you. If you're not a shareholder, I hope you become one. And if you want to sell, well, so be it. Finally, the result that has just been brought out can best be described as a tale of two cities. It is showing the very strong forward look in terms of revenue, and now that we are profits, but we have consciously taken the decision in the quarter just ended to housekeep. So anything that looked dodgy, sideways, or a bit smelly has been cleaned up. So people are aware of the fact that there have been changes within the organisation in terms of personnel. All of that has been accounted for and dealt with in the quarter just ended. The aim being that what we want for the proprietors and for the employees and management of the company is to go into 22-23 in sparkling form and without barnacles and dags hanging off the company. So that's enough from me. I'll hand over to Andrew Smith to give you an idea of how things are going and what you can look forward to. Thank you.
Thanks, Hugh, and certainly thanks to the support of the board, who've certainly assisted in what's been quite transformational in terms of the business. I firstly wanted to thank everyone who'd stuck with us over the recent sort of technology sell-off. I think you'll be very pleased in terms of our outlook moving forward. And as far as Credit Clear's position, we mightn't be lithium miners, but we're certainly going to benefit greatly from market conditions as they start to bring more challenges to that sort of accounts receivable debt collection space. So from my perspective, being positioned in the market where we are today, with rising interest rates, continued pressure in terms of household debt, inflation rates, and greater focus on regulatory environments into the debt purchase world, Credit Clear is very much well positioned to take advantage of those conditions and grow exponentially as it comes as we progress into this financial year. So this result is absolutely a huge team effort, and I'm really pleased to have two people on this call that are fundamentally important to that effort. So Jason Serafino will be talking later in the presentation, who's our Chief Product and Technology Officer, who continues to maintain our performance levels to outperform other agencies or other digital collections platforms in this space. And also Eddie Smith, who leads our group sales team, who's been delivering a great component of that growth that we're focused on and going to talk about in a couple of minutes. So let's just talk about some of the highlights as we move into this particular financial year and we look at last quarter. New monthly revenue record set in June of 3.12 million. That was off the back of a record revenue month in May as well. So for those who have been watching the monthly updates in terms of revenue and profitability, it's good to see that this was our best month followed by our best month in the quarter. When we compare the revenue of last quarter, this prior corresponding period to this quarter, we can see 160% uplift and a 41% uplift in terms of quarter on quarter. So that gives us a combined run rate right now of 37.44 million, but that doesn't really include any new clients that have signed that we're not seeing any revenue from, or existing clients that will be signed in the coming months that will contribute to the revenue for the next 3 quarters or 4 quarters. You'll probably hear me say this a few times, but consecutive operational profitable months in May and June, despite the fact we were still shedding some of those costs that Hugh alluded to earlier, was something that we're all very proud of. Clearly there's been a change in economic conditions, but also there's been a change in terms of capital markets. So I think those technology companies that are burning through cash and at exponential rate are no longer going to be able to raise cash in the same rate or at the same valuation. But what I'm very pleased to see is that in a very short period of time, we've been able to bring a disciplined approach to the business, reduce costs, while still keeping a key focus on the technology investment in Jason's team, and also expand and grow the sales team. And that's been demonstrated by 60 new customer wins during the quarter. So a very, very good quarter in terms of customer wins, without doubt the biggest number of customers that have been won across the group in a quarter, and an indication that that sort of combination of the traditional Armour collections business combined with the award-winning AI-driven digital technology business in Credit Clear is really being well received by the market. And I can clearly say that there hasn't been anything like the pipeline that we've got in any years that I've been in this industry. So not only clients are really responding well to it, it's clear that customers are performing in terms of having a digitally led collection strategy as our key indicator for future success. So that's a really good result. I'll get Jason to expand more around what Credit Clear is doing from an AI-driven software in terms of uplifts to recovery rates. So I'll just give you a comparison in terms of the last few quarters, so you can see just in terms of growth that we've been able to deliver. As hopefully most of you are aware, it was early February that we closed the deal with Armour in terms of combining the two companies' revenues. So that would have driven a significant amount of uplift in Q3. But in terms of Q4, that is a strong combination of not just combined revenue from Armour and Credit Clear, but also strong organic growth from two really key areas. One is in existing customers that have actually increased the amount of work that they've been giving us due to the fact that, market conditions have driven a greater percentage of accounts into arrears, or in fact that there have been regulatory releases in terms of moratoriums on debt recovery, and they've been released out to third-party suppliers like ourselves. So that's a big driver in terms of growth. But as we said earlier, there's been 60 new customers that have driven significant growth in terms of organic uplift. So there's some really significant tailwinds that driving that growth and getting us to a point where we did an $8.6 million turnover month, and off the back of a $3.12 million turnover month in June, we're really, really well positioned to start this financial year with a great month. So we're certainly well on track to have another record month in July, and August being a 23-day working month. Hopefully that can continue the trend and have 5 months worth of consecutive record months. So that's the current position we're at the moment. Just some sort of operational highlights as well. So 696 active clients. This is compared to 1,038 total active clients. So the way that we're looking at clients now is those that have given us work to the volume of actually over $1,000 billing per month. So we're reporting on that slightly differently to before. So having brought on 60 new active clients, you can see that sort of getting closer to 10% growth in terms of client acquisitions, in terms of growth this particular quarter. So very, very pleased in terms of that volume. What we've also seen is an increase of 13% in our active customers under management. So that's creeping up from, towards that 1 billion number of customers under management to 831,000 active customers. So a very large proportion of customers that are under management with Credit Clear. 4.8 million digital communications for the quarter, once again up by 17%, and 297,000 transactions for the quarter as well, so up 23%. We're now looking at $63 million worth of total committed payment plans, and I suppose the way that I look at those payment plans is our future income come through those payment plans, our clients' future incomes come from those payment plans. So as we build that baseline asset, we can really look to the future and have a bit more predicted, we can predict future income coming from those payment plans flowing through in the coming months. As I said, we're going to talk about, the fact that we've been profitable the last 2 months. We're very, very pleased with that. But May and June being profitable in 2 consecutive months and a strong cash balance of $10.2 million, I think really sets us aside in terms of those fast-growing technology businesses that maybe were running out of cash, going to the market, raising capital, and whilst valuations in terms of multiples of revenue are really exponential, a lot of fund managers I've spoken to are that sort of those times are really over at the moment. So being in a business now that's really got a strong balance sheet, a strong cash balance, a clear profitability outlook is something that I couldn't be more pleased with in terms of how we're positioned. And that's supported by really strong revenue growth, having materially improved this quarter with all parts of the business achieving strong growth. June was particularly strong with a record month of 3.12. I know I've said that before, but it really shows momentum gaining in terms of, Credit Clear as a full hybrid end-to-end offering. So really pleased about that's going. And the cost base is in line with revenue growth. As I said last quarter and in a number of updates that I've given to shareholders over the last sort of 5 or 6 months, I come from a privately owned run business, and the discipline that we bring in terms of supply negotiation, holding people accountable to their performance, those changes have really come into play. And what we're seeing is that not only has there been a reduction in sort of cost in terms of wastage, as we've reinvested some of that profit back into the business, we're investing in areas that are really going to have a meaningful impact in terms of growth, profitability, create more of a moat around our product in terms of our competitive advantage, and also take advantage of those market conditions that I spoke about earlier. So that's been fantastic. Margin uplift. I've sort of witnessed firsthand in terms of the power of Credit Clear's digital collections tool, driving a significant margin uplift within the Armour acquisition. Our clients have been completely blown away in terms of the uplift in terms of collections, supported primarily by very strong net promoter scores. So not just driving recoveries through additional technology supported by call centers. What we're actually seeing is a very, very increase in the satisfaction of customers. So, making people's lives easier and making it easier for people to pay a bill when it's overdue is what we're about. So that's been transforming our traditional business in the Armour space to a more modern, digitally led collections process. Now we're going to talk about the international update, and as I said earlier, we look forward to welcome Jason Serafino, our Chief Product and Technology Officer. So he'll lead this discussion on international, and I've got some things to add later on as well.
Okay, thanks a lot, Andrew. So international remains a big priority for us as we move into our FY23 plan. And we do feel that the partnership with Tech Hub in South Africa is a very good blueprint, where we bring our proven market-leading technology into a partnership with an organization that already has a large volume of clients and customers, and we can rapidly scale together. And that kind of partnership is very appealing. It's a low CapEx outlay for us to just deploy the platform. It's a low risk approach where we're going with a partner into a proven market. And we've proven our technology is transportable. We've deployed it to South Africa in a matter of months. And it is a distinct advantage to us as a cloud-based SaaS platform that we can deploy to any region in the world where there is cloud. And it's been compelling to our prospective partners in talking with the UK and Singapore and others that we've now done it before. So interestingly, as we're talking to these partners, we're talking to these, these large agencies in UK and Singapore, they are telling us that they have similar circumstances to Australia and that our technology is differentiated. They're telling us that, particularly our AI, our behavioral-driven workflows, our champion challenger testing is technology that they don't have. And in fact, they haven't seen in the market there. So conditions really do seem to be, very right for expansion at the moment. And with our partners, as is happening with Tech Hub, the benefit of bringing in digital is to their existing client base, but it's also an advantage to attract new clients, as we're seeing with Armour, as Andrew just said, that digital advantage can be a bit of a game changer in terms of bringing in new business for our partners as well. So into South Africa now, we're working through our program of testing and optimization. This is a large, complex, sophisticated implementation, and there's a number of aspects for us to optimize and get right. So after a number of tests and tweaks, we're now happy with the SMS side of things. Pleasingly, we're seeing very similar delivery rates and engagement rates by customers as we see here in Australia, for example, in comparison to our ARMA consumer portfolio. So that's a big tick. We're looking now into testing on the email to get the same results there. And then we'll be moving increasingly into a digital first approach with Tech Hub, where we'll be treating portfolios that haven't otherwise been treated. And that will be the big comparison point and test going forward.
Yeah, no, I think, Jason and his team have done an incredible job. I don't want to, to downplay the amount of work that's involved in terms of deploying, the Credit Clear technology to a completely new geographical region with, different regulatory requirements and huge difference in terms of data sovereignty requirements. So it's actually been an incredible, deployment, and one that, has clearly happened very quickly, considering the time it would have taken to get it off the ground if we opened an office over there. So incredible job from Jason and the team, and it's sort of getting to a point where a lot of testing's been done, and we're starting to go live in terms of collections. And it's just coinciding with the fact that Lewis Romano, who's driving a lot of this international expansion, and myself are going to get on a plane and head over to South Africa to see our business partners over there in Tech Hub, and really talk about how we can exponentially expand in that market, and share some of the case studies of success with ARMA, as we sort of see ourselves very similar to a Tech Hub business in terms of how we operate, and share those case studies and leverage that in terms of momentum to, deploy the technology in a greater volume amongst their existing business, but also use it as a competitive advantage for Tech Hub to win more work within what is a pretty competitive collection space within South Africa. So yeah, wonderful job by Jason and the team, but certainly in terms of being able to go and capitalize of the deployment now, Lewis and I will be there next month, and we'll continue on to the UK. We've got some pretty exciting partnership opportunities that we've been working on, for the last 6 or 7 months. And then back past Singapore, where there's, two very, very big opportunities where we can talk through license agreements with large APAC debt collection provider as well. So yeah, look, I think whilst Australia has been a key focus for me and the team over the last 6 or 7 months as we transform the business, I said from a fast growing tech business to a full end-to-end digitally led collections business. It's been very exciting to have this bubbling along and gaining momentum. So it's really at that stage where I think, we look to see some promising results coming in the next quarter.
And sell out world tour.
Yeah, well done.
So onto case studies and ongoing validation. And if you watch prior updates, that you'll know that we work in a very scientific manner, and that our platform provides the capability to run champion challenger experiments to constantly tune results, looking for better and better results. And we do that. The platform supports us to be able to take a cohort of debt and randomly split it between 2 different treatments, and then statistically, scientifically measure the difference between those, and we can learn about uplifts. And we've got a few things that have happened recently, actually, I think in the last 6 weeks or so, as examples of that. Turning to the right-hand side, there's 2 interesting ones here. They're interesting in that they're optimizations over the top of an existing client's workflow. We already had digital, we already had optimized messaging, etc. And yet with further tweaks, we've been able to get further uplifts. So for the financial services example, further optimizing that workflow delivered 3% and 5% uplifts in 2 portfolios. It's significant in a already optimized portfolio. And we saw a 41% increase in collections for larger debts over $1,000, which is really interesting. Excuse me. And similarly on a water utility, a very big client that we've been working with for a long time, further optimization delivered 22% uplift in collections, and 8% uplift in engagement. And what this tells you is that it isn't just a set and forget. We don't just run a workflow and it's a perfect workflow and you forget about it. There's constant changes in circumstances. in the environment, in the economy, with those customers that we're constantly tuning and testing to find an improvement. The really exciting one for me is the one on the left, though, and that is a test of our AI. In this is a pure AI test. So in this, what we did with a large toll road operator is the comparison. So excuse me, and the comparison was between two cohorts. They both had our optimized messaging. They both had our platform. They both had phone calls in them, and the only difference between the two of them was AI. We wanted to test out the efficacy of our AI. So in our challenger, it's the AI that's deciding what's the next best message or action to take with this particular customer. So every customer is going to get a slightly different journey. One customer might get an SMS followed by an SMS, depending on what they did, maybe followed by an email, maybe followed by a phone call. Another customer the AI might say, no, this customer needs to get a phone call straight away. And the difference between those two approaches, we delivered a 35% uplift in AI, which is a huge difference. And what I really love about this, AI, I think, is a really interesting, sustainable competitive advantage. You need a lot of data to build AIs like this, and we have years of it. It's very hard for a new entrant to recreate that. You need a lot of technical skill. You need a team of specialists, data scientists, etc., which our prospective partners or clients, they simply don't have that capability, and it's a black box. It's the secret sauce. So it's a really good protection of IP. So really exciting one.
Yeah, no, I think you make a very good point there. Credit Clear was visionary in terms of this sector, where us as traditional collection agencies, maybe 6, 12, 8 months ago, we started panicking that we needed to, start to invest in this space and recognize we're a long way behind the 8 ball. So, really, really keen to hear from Eddie Smith, who's our head of sales, who leads the team in terms of, navigating our way through these economic conditions and trying to position the Credit Clear offering end to end with lots of different organisations. So really keen to hear from Eddie, and welcome him to the presentation.
Thank you, Andrew, and morning, everyone. Yeah, as Andrew mentioned, my name's Eddie. I head up sales across the group, and excited to share with you some, how we've executed on the strategy, but also what the pipeline looks like going forward. I think if we look back at the quarter, to be able to convert 60 new clients is something that I guess I'm most proud about, how the team's been able to execute on that. I think that's largely driven by the momentum and capitalizing on, the excitement around the acquisition earlier in the year, but also their ability to be able to differentiate our offering compared to other competitors and really allow us to be seen as that unique offering that clients are really looking for at the moment, to be able to assist them across the full end-to-end collection lifecycle, which has allowed us to convert a lot of these opportunities that were in the pipeline pre-acquisition, be able to collapse those sales cycles really quickly as we've strengthened our value proposition and the solution. But also it's allowed us to open up a lot of doors, as a lot of the market is very interested to understand how this hybrid offering and the end-to-end solution is really going to be able to benefit them, and being able to solve multiple issues at once is been really exciting for the team. Additionally to that is, in partnership with Jason's team, is our ability to be able to get the new customers, supporting them as quickly as possible, being able to achieve amazing results. And that has allowed us to broaden the conversations with them and look at things like upselling and cross-selling across our different products. And we've got some really exciting conversations going with some of our existing customers as their challenges continue to increase and the debt levels that they're faced with are continuing to grow as well. But if we look at some of the 4 key sectors that we're really looking to focus on over the next 12 months, we've identified them as government. Now, we know government is a huge opportunity for us across the group. We've got a lot of great experience and runs on the board. And we look at it in 2 ways. One, our ability to be able to achieve great results for them, but they're really turning to us as a supplier that can assist from a compliant perspective, but also to be able to offer controlled environments around how we communicate with their customers, and especially through the digital platform. Now, we've also looked at how we can have a dedicated resource to be able to make inroads into some of the larger networks there and the contracts. We're fortunate to have a very experienced salesperson who's worked on a lot of these tier 1 contracts, and their role will be dedicated around how we can convert that particular industry. Financial services, we know, being one of the largest addressable markets, especially here in Australia. And with the current climate that we're faced with, we know they're looking for partners that can help them with their ability to be able to communicate with their customers in a cost-effective way. And our solution really talks to how we can assist them there. Insurance is one that we're very excited about, and I think one that really separates us from anyone else within the competitive landscape. I think what we've been able to build there with our major customer, a major insurer, has really changed the way that insurance is looking at recoveries and collections. I think they were crying out for someone to help them on the digital journey, and the ability to be able to create a digital workflow in what is a very traditional or outdated recovery process has meant that they've been really excited around what that means from delivering really good results, but also looking at how they then communicate with their third parties or ultimate customers, as well as they think about how they change their perspective around communicating to the stakeholders that they have. And then lastly, utilities probably been in hibernation over the last 2 years due to government policies, regulatory requirements. We know, and we've been hearing from our clients, that they will need to look at new strategies and new ways for them to be able to work with their customers across the entire collection lifecycle, and our ability to be able to service that through digital early stage collections as well as late stage collections, as they are faced with challenges around customers with growing balances as consumption increases, or due to not being asked to be able to pay those bills back as frequently as previously had, means that we're set up for success there to really be able to capitalize on that and assist them as they think about their new strategies going forward. I guess in summary, look, our main focus is continuing to look at those key growth sectors for us and across those 4 sectors there, continuing to speak around our competitive advantage and differentiate ourselves from our competitors, and then talk in the language of our customers, which is very much around that customer-centric focused collections, and our ability to be able to track that through NPS scores means we're very different to any other provider out there.
Yep, thanks, Eddie. Nice wrap up, and I hope it sort of highlights just the sort of scale and scope of the opportunity in the market for us just domestically. So a lot of those are transformational across international borders, but at the same time, we've got a very, very big opportunity right here with interest rates increasing. Hearing about mortgage stress coming in, right now. The RBA was announcing some pretty interesting information this morning around if there's a 3% rate rise in the coming months, then that could mean a 40% increase in terms of the average mortgage repayment. So there's lots and lots of indicators that are going to force a greater focus in terms of managing those accounts receivable focus, and certainly having a digital led solution aligns it with a lot of these companies' strategies moving forward, which is great. And Eddie's going to be leading the team that's going to take most of the sort of effort in terms of bringing those on board. All right, just about ready to wrap up. Just a summary in terms of the key points. Current revenue run rate of $37.44 million. The best part about that is that that doesn't include any existing customers that we've signed that we're yet to start deploying and working on. We've got a couple of very major clients that we've already signed that should form 2 or 3 of our top 10 billing clients next year. So that's very exciting that we've already got growth booked in terms of future client revenue. The other thing that we've not really included in the budget, or not included in the budget, is in terms of international revenue from TechHub. I don't want to put any sort of additional pressure in terms of international expansion right now, but following the sort of presentation from Jason, it's pretty clear that it's going to be revenue coming out of TechHub in the coming months, and we really want to see that grow in terms of cream on top. The other thing that is going to be a key focus, and I've said in the last quarterly, is that we want to focus on profitability moving forward. I believe that we can be a fast-growing technology business whilst we still are able to grow and expand and take advantage of the opportunities in the market now on our own steam. All right, and any future growth expansion, we should be able to fund through existing profits being reinvested in the business, and on top of investing in our, competitive advantages in terms of artificial intelligence driven collections, optimizer, customer success, analytics, and propensity to pay modeling. So that's really exciting as well to continue to grow whilst investing in those key areas. I've already talked about international expansion and our trip to the UK and Singapore. I guess watch this space, see what we can figure out in the next month or so. And new business pipeline, as Eddie talked about, I don't think I've ever been in this position where we've had so many tier one customers coming to us, inviting us onto, tender submissions or proposals. And, in terms of leading indicators, that's probably one of the greatest leading indicators for future success. So really exciting to be dealing with, almost all the major utility companies, telecommunications businesses and financial services businesses, and really commencing our journey with those top tier, government clients like, say, the ATO or Department of Treasury, and seeing where that can take us in the future. So great time, really proud of the team. I thank everyone who's sort of stayed with us in terms of a shareholder perspective, but, exciting times ahead. Keen to take some questions, if there are any.
Feel free to either put them in the chat or just take yourself off mute.
That Trent?
Hey, Andrew, how you doing? Thanks very much for the presentation, guys. Andrew, you focus a lot on the growth prospects of the business, and that's very important and totally appropriate. But I just want to go back to something that Hugh mentioned just as the introduction of the call. One thing that really popped out for me looking at the 4C was the increase in admin and corporate costs for the quarter. The typical run rate through the year had been around about $2 million a quarter, and we're up to $5.5 million in the fourth quarter, which is about 45% of the total costs. Now, one of the things that, of course, that's attractive about the business is its scalability, its operating leverage, but we've seen the costs in that fourth quarter really keep pace with the revenue growth. And I just wondered, two questions really. I just wondered whether or not we should expect that to fall back more in line with what it has been in the past, those admin and corporate costs, and whether on and what is the composition of those admin and corporate costs? What has been put in there to recognise some costs that Hugh mentioned a little bit earlier, to really sort of explode that number? Perhaps Victor could comment on that as well.
Yeah, look, I'll make a first comment, and one is that, whilst we're a digital technology company, we still need to have a traditional call center offering to support those clients that don't necessarily solve their problem through the digital portal. So, any new clients that we're signing in that sort of space, whilst, the reason why they're using us predominantly is because of our artificial intelligence delivery of the service. There's always going to be a combination of those people that need to talk to someone on the phone. So, for example, some of the new clients that we've won, we've needed to put on, extra headcount within the call center to handle the overflow. And usually at the beginning of those contracts, that's when you're loaded up in terms of extra operational costs. So it takes about 2 or 3 months before you get to the stage of being able to pare back on that sort of onboarding cost, or in fact, the hard sort of labor costs in terms of handling the transition from, onboarding to deploying, and then sort of streamlining that sort of margin uplift in terms of maximizing the digital offering supported by that traditional bums on seats call center offering. So that's a big part of it. I'm not sure I can comment on exactly the split between administration costs from some of those. I'm not sure what Hugh called them, but he referred to them as, some DAGs, I think, in terms of getting those costs through the business and through the quarter, and then clear that so we can start this financial year fresh and free. So do you have anything else to add there, Victor, in terms of, those administration costs?
Yeah, I do, Andrew. I might just break that figure down, Trent, because it is important. that figure is misleading and not representative of current business performance. So we got 5.4 million in there. We had quite a few DD costs from the ARMA acquisition that carried over from March quarter activity that were eventually paid in the June quarter. So that's a big part of it. We had we went through a cost cutting or cost review initiative there. So there were some redundancies. We had some tax liabilities from the March quarter that carried over into June quarter, very beginning of June quarter. So obviously that inflates the 5.4. And remembering too, if we're going to compare to the March quarter, we only had 2 months of ARMA as a business part of the group, given they came on from the 4th of February, as opposed to 3 months in the June quarter. So they're the drivers there. You've got ARMA costs coming in for a full 3 months in the June quarter versus 2 months in March quarter, and around $1.2 million in those ad hoc type expenses, which will not be recurring. So that's important. They won't be recurring. So you'll see that figure coming down for the September quarter.
It's great, guys. Very helpful. Thank you very much.
That's right. Chris, still got your hand up? All right.
Oh yeah. Hi. Just again, another 4C question, maybe for Victor. Just can you describe the difference between the revenue recognition and the receipts? Quite a big difference.
Look, generally they're aligned. Sometimes you'll have some large clients that, and we work on a monthly cycle, by the way, Chris. But some of those big accounts, if they're a few days late, they tip over into the following month, and that tends to skew the difference between, accruals accounting, if you like, and cash recognition, which is what 4C is based on. But we're running at about $3 million in revenue at the moment. That's currently. This is June quarter. April was a little light due to Easter and public holidays. So if you look at the receipts from customers there of about 7.8 million, that's going to be averaging 2.6 million, which is about where it was in April. But we had some receivables there outstanding at 30 June, which have since been paid, by the way. So that's why, that 7.8 is a little lighter than what you may see. But again, it's to do with timing. So September quarter, that 7.8 should be closer to around $9 million, just on the basis of $3 million revenue per month.
And the operating profit, what's the definition of operating profit? Is that EBIT?
It's predominantly EBITDA, but it excludes some material DD costs, again, for the ARMA acquisition, remembering we only completed that in February, and some of those costs filtered through into subsequent months. It excludes redundancies. They're the main reasons there. So, we try and exclude those non-operational so that it doesn't distort our true operational performance.
Yeah,
but it's mainly DD, and you'll see them, and some legal expenses for one-off matters, but you'll see them, and they're already starting to decrease now.
And you received government grants during the quarter. Is that included in the operating profit?
That is not, in fact, no. That's to do with the R&D tax incentive from the prior year. So that came in as a cash receipt, but we do not include that as operational.
Okay, cool. And you're not going to give the quantum of the operating profit?
Sorry?
You're not going to give the quantum of the operating profit?
Oh, look, it's still, it's not look, it's growing, okay? So they're still on the smaller end, but we're excited with where it is at the moment. We've come a long way. If you have a look at some of these reports from 3-4 quarters back, where we were burning $500,000 to $600,000 a month, We've got that down almost to break even. And as I said, the profits are small, Chris, to be honest. But, you know, they've got to start there. And when we're giving this presentation in 3 months and 6 months' time, they're going to be more material. Remembering what Andrew said earlier, though, we are, you know, reinvesting in the tech development platform because of the results we're getting that Jason's explained. Eddie's explained sales. We're you know, winning lots of clients. We want to expand the sales team, and we'll continue investing on client onboarding. We've got clients that are banked up, waiting to come on board. And there's a little bit of a delay there due to resourcing, and that's we've got to rectify that. So we're hiring, putting on more resources to get clients on quicker, both for client servicing reasons, as well as, you know, the sooner we get on, the quicker we can generate revenue and collect payments for our clients.
Yeah.
And that operating profit, I mean, you're not capitalising development in that?
Yeah, we do. So, you know, the run rate there over the last 12 months has been broadly 40% of tech development being capitalised. Okay. But, you know, 60% is going to OPEX.
Yeah. All
right. And there are obviously accounting standards that guide, drive all of that, and we need to comply with that. So 40%, look, we'll ramp up tech development. That 40% CapEx percentage may grow to around 50%. It just depends on the nature of the work, you know, at any given month or quarter.
Yeah, and sorry, just one more question. It was just the previous question. You said what the non-operating costs were. Did you say 2 million on that previous speaker's question?
Yeah, a lot of that was in relation to the ARMA DD costs. So, you know, you've got legal costs there, you've got capital raising costs, you've got all the external advisors, the accountants, the tax advisors, but that's not all DD. There were some other legal costs, as well as redundancies as well, again, coming out of the expense review. You know, we looked at expenses line by line and assessed the return on that expense, that investment, if you like. And where we couldn't see a foreseeable return on those expenses, we made some decisions. And that's helped us to get to a profitable position. It's worked well for us. You know, the market's looking for fundamentals. Everyone on the call knows that. So we've got top line growth, expense management discipline, cash in the bank, $10.2 million. And we're profitable. So I think that's a really important pivotal point for this business and where it's at the moment.
Yeah.
And what the outlook looks like.
Victor, we might, and Chris, we might take the rest of those questions offline. Chris, you're more than welcome to get in touch with Victor. If you don't have his email, Warwick Lace can connect you. So in the interest of time, I'll just ask if there are any more questions. Otherwise, we will close the call. No, I think that's it. So thank you so much, Andrew, Victor, Eddie, Jason, and the rest of the team, and congratulations on an exceptional result.
Thank you very much, Catherine.
Thanks, everybody.